Hear ye, my fellow silver bugs. We have Wall Street Silver still on the rise here. Number 7 on growth on Reddit. Now, this is just behind Wall Street Bets, who's number 2. We are at number 7. That is insane. And by we, I just mean us silver stackers. I don't run Wall Street Silver or anything like that, though I do talk about them a lot. Because for me, I like throwing a lot of shine on things that are pushing silver and gold. Now, today is a big day because I want to talk about inflation and particularly what we got yesterday because I know a lot of people have been talking about, well, hey, Wall Street has been shaking off all of the inflation pressures. And obviously, if we take a look at the price for gold and silver today, they're kind of choppy. Silver's at $28 right now. Gold has been coming down. What's going on here? I want to let you guys know that I've been reading, looking at what happened as far as the inflation numbers are concerned, and things are looking pretty good for silver prices. Now, let's begin here with U.S. consumer sentiment because it also touches on inflation. Now, we got the numbers today. It bounced back from dipping down in May at 82.9 and bounced up to 86.4. Now, if we take a look at some of the qualitative information that we got from the preliminary consumer sentiment info, a lot of the respondents were talking about economic prospects rather than the current conditions within the market. And the majority of this write-up is concerning prices and concerning inflation. So let's take a look into it. And I quote, "Rising inflation remained a top concern of consumers, although the expected rate of inflation declined in early June. Spontaneous references to market prices for homes, vehicles, and household durables fell to their worst level since the all-time record in November 1974. These unfavorable perceptions of market prices reduced overall buying attitudes for vehicles and homes to their worst point since 1982. These declines were especially sharp among those with incomes in the top third, who account for more than half of the dollar volume of retail sales. Fortunately, in the emergence from the 2020 issue, consumers are temporarily less sensitive to prices due to pent-up demand and record savings, as well as improved job and income prospects. The acceptance of price increases as due to the 2020 issue makes inflationary psychology more likely to gain a foothold if the exit is lengthy. While expansive monetary and fiscal policies are still warranted, the accompanying rise in inflation will cause uneven distributional impacts. Those impacts have already been noticed in June among the elderly and lower income households. A shift in the Fed's policy language could douse any incipient inflationary psychology. It would be no surprise to consumers as two-thirds already expect higher interest rates in the year ahead. And the reason why they expect that is because they expect inflation to rise. Now, the reason why people are saying, well, hey, consumers are just going to go out there and spend and accept the higher prices. If we take a look at the personal savings rate in the United States, especially over time, over the last several years, pre-2020, we've averaged around 6%, 7%, 8%. And since 2020, we got as high as 33%. Currently, the data we have is for April 2021. We're at 14.9%, so double what we usually have. And when that and what we should be expecting is for that personal savings rate number to come down to the average here and revert back to the mean. That means people are going to need to start spending in the United States much more than they have been recently. And if we take a look at the savings rate from what we got in April and take a look at the inflation rate relative to the CPI, we had a 4.2 rise in the CPI. In May, it rose to 5. Now, yes, people have been talking about the lessening of the base effects here, going from 1.5 to zero point 0.3 to zero point 0.1. But that's only part of the story, because what a lot of people, especially in the Fed, would like to say is that, well, a lot of the price pressures are just transitory. Don't worry about it. It may last for several months, but things are going to go back to normal, possibly back to pre 2020 levels. I say hold the phone just a bit, because if we take a look at core CPI, all items less food and energy, as you can see, energy made a huge leap in May. Food was also pretty strong. And, we had a number that gave us 5. But if you take a look at core inflation, it was pretty high. And relative to core inflation increases, you can see here on Trading Economics that it is pretty high. It's at 3.8. Last month we had a 3, and the month before is at 1.6. And again, I keep talking about April and May. April and May were big months, not just in the US, but also it seems like in the world over, as far as inflation rates are concerned, as far as the ISM is concerned. But if we go back to the US inflation calculator, here's what one analyst had to say about the quote unquote transitory factors. They said, this is an economist from Morgan Stanley, and I quote, while transitory factors did a lot of the heavy lifting driving the May upside, the more persistent components like rents and OER firmed up as well, much more than expected, pointing to a firmer source of foundation for the inflation data as the transitory factors begin to fall out of the figures. Now, why are rents and OER so important here to the story? Well, Barron's has some key insight here as to why in this article entitled Inflation Climbed More Than Expected in May as the Transitory Debate Heats Up. And long story short, in the beginning of the article, they talk about the spike here. This economist from Jefferies says, the April inflation spike may have been dismissed as a one-off, but there's no such thing as a two-off. The report showed broad-based and persistent strength. And then at the end, they said, this isn't just cost-push inflation, this is demand-pull inflation, which should raise some eyebrows at the Fed. Now, this is the part I want to focus on a bit more, because they start talking about core CPI. And I quote, while plenty of the again stronger than expected CPI report can be dismissed as transitory, says city economist Veronica Clark and Alan Hollenhurst, they flag rent prices as a sign of something more. Again, the Morgan Stanley economist in the previous article said the same thing. Now, this is key here. In particular, Citi says the 0.3% increase in owner's equivalent rent, or OER, tends to be a more persistent component of inflation that wouldn't be considered transitory. Okay. Well, what else do you have to say here, guys? They say, Clark and Hollenhurst say, the OER component began to firm a few months ago, several months sooner than they had expected. And they say the return in May to a pre-2020 pace is also earlier than they had anticipated. And I'll pause right here. I will say that for myself, anecdotally, I actually moved to a new apartment in the city that I live in back in January. The landlord that I had, I live in a condo. The landlord that I had was literally trying to give away this unit. I even asked him point blank. I said, hey, is anybody else looking at this apartment? And he said, no, you guys are the only ones. And to give you an idea, this apartment basically on a monthly basis is $700 less than what it was originally listed to be at. This guy was essentially just throwing this thing at us. And we even said, because I live here with my wife, we have two cars. It was only giving us a space for one car. And we said, hey, you mind throwing in another space? He said, you know what? I can give you that with no additional cost. So now, obviously, things have changed. Rent prices have been correcting, as City has pointed out. And as they say towards the end of this highlight, you'll see why this is important. Clark has said that the OER figure tends to lag behind home prices by 12 to 18 months, meaning rocketing housing prices should start to show up in the CPI, if indirectly. And Sung Wan Son, professor of finance and economics at Loyola Marymount University, calls the shelter increase worrisome. The component accounts for a third of the CPI, and the primary rent prices, as opposed to the owner's equivalent, haven't risen as much as they otherwise might have because of government restrictions on eviction. What happens when the moratorium on the eviction ends, he asks. Very, very key. Now let's take a look at what Bloomberg had to say as well on inflation. Now, within the report, when they looked at core CPI, they took a look at some of the opening or reopening categories that are starting to see some outsized price increases. And if you take a look here, some of them have to do with travel. Vehicle rentals up 12.1%, airfare up 7.0%. Now, I will say that, oh yeah, and used cars and trucks are up as well. New vehicles are up. Remember, the semiconductor thing is an issue right now currently. So you could say, hey, that could be a bit transitory there. But when it comes to airfare, we all know that the airlines are struggling right now. And the one thing that people may not know about the airline industry is that the majority of their revenue comes from the high payers, the business class, the first class people. They get a lot of their revenue. A lot of that business travel happens towards the back half of the year, September, October. But they also try to make up for the other portion, which is just, commercial travel and stuff like that during the summertime. So this is a big time for them as well to start making money during the summer. And it just so happens that we're starting to see reopenings happening right now in the summertime. And you may say, well, hey, does that necessarily mean that people are flying? Well, one of the great ways is to take a look and see what the demand is like in airports is to take a look at the TSA checkpoint travel numbers. And you can take a look at it for the past current year and the 2 years prior. And as you can see here, during 2020, we were at, in the six-figure territory. In 2019, we were at 2 million, 2.5, you could say, roughly around that area. But in 2021, as you can see, we're edging back up to the 2 million area. So we're not too far off from where we normally would be if it hadn't been for 2020. So people are getting back into the airports at high numbers. And anecdotally, again, I've been traveling pretty decently within airports, and I've been noticing a huge increase in travel over the past few months. It's almost kind of like the airports are just like, 2020 didn't happen, we're ready to travel. So to see that prices for airfare has increased so much, I'm not surprised. So guys, all of this stuff isn't necessarily transitory. We're starting to see prices rise for airfare, not just because of the reopening for travel, but we should also start seeing it again reflect itself in the back half for business, where airlines will be making or hoping to make the majority of their money because of business travel. And going back to the original argument about the inflation coming from rent prices or OER, That is huge. That's not necessarily a transitory factor. So that brings us back to silver prices and gold prices. Yes, currently, right now, today, things aren't looking very stellar, but that's not necessarily what we should expect in the future. So, guys, let me know what you think about all this in the comment section below. Thanks again for watching. Please hit that like button. Please subscribe if you're new. It's Black Bullion for gold and silver today.com.